Most high school seniors probably don't spend a lot of time watching the US Treasury market, but thanks to this year's sell-off, it will be a lot more expensive for them to get a loan for college. Student loans distributed this year will carry the highest rate in years, 4.99%. I'm going to explain how federal student loan interest rates are calculated, why rates will be so much higher this year after touching a record low just 2 years ago, and what this means for the cost of a college education. Let's get into it. The Department of Education determines student loan interest rates by combining a fixed add-on rate with the yield on 10-year US government bonds at the last auction in May. That just happened. Undergraduate students receiving loans from the federal government get the lowest rate. For graduate students, it'll be a little more than 1.5 percentage points higher. And for professionals, or those receiving a Parent Plus loan, the rate will be a little more than 2.5 percentage points higher. One of the few good things to come from the coronavirus pandemic was that students who started college in 2020 got to lock in the lowest student loan rates in history. The pandemic brought on a recession and expectations for weak future economic growth, which kept Treasury yields near record lows in May. Unfortunately, for students headed to college this fall, those days are over. Treasury yields in 2022 have risen at the fastest pace on record to start a year. That has been the result of high inflation and expectations for the Federal Reserve to raise US interest rates at an accelerated clip. Because the 10-year yield spiked leading up to May's final auction, the rate locked in by student loan borrowers will be the highest in years. Unlike with other loans, the rate on student loans is not influenced by credit score or financial profile. This will make the cost of borrowing for college a lot more expensive. Undergraduate borrowers who got their student loan in 2020 and borrowed the maximum $5,500 in direct loans will pay about $800 in interest over 10 years. That same borrower who got a loan last year will pay almost $1,100 in interest. And this year, that borrower will pay almost $1,500 in interest. That's almost double what they paid 2 years ago. And while the interest rate doesn't change during the year, students borrowing for the typical 4 years of college will get a different loan rate each year. The rate for federal student loans is generally lower than private student loans, but not always, since those are based on credit and typically require a cosigner for the student. There's currently about $1.75 trillion of student loan debt outstanding. That's likely to rise even more soon, unless President Biden goes through with his controversial plan to forgive them. And with higher interest rates driving up the price tag for college, expect this to become an even more hot-button issue.